Welcome on and all to another live webinar with us from Phillip Futures. This is your facilitator of the day. My name is Sri. And if you can hear me, please type a resounding yes in the question box and I will have the confidence that you can hear me, and sound-wise, we are all good. All right, thank you, Vince. Anna, thank you for confirming that you can hear me. Well, today we will be discussing understanding Bitcoin and the cryptocurrency landscape. It will be your primer to what cryptocurrencies are and what you need to know about them. And with us in the studio will be Wan Zuhao. He is the Chief Technical Officer of the proprietary trading group Synergy Link Capital. He specializes in global macro trading using a wide range of instruments, including futures, options in equity, commodities, fixed income, forex, and volatility. He has a strong quantitative background in statistics and machine learning. What will we be covering today? What is Bitcoin? The different vehicles of Bitcoin. If you have any questions at any point in time during the live webinar, please go down to the question box, the one that you just visited, just to type yes into, and type your questions in there, and we'll do our very best to address them during the Q&A at the end of the webinar. Zuhao, if you're all set up and ready to go, I can hand the reins over to you. Zuhao, please.
Well, thank you. Thank you, Sri, for the very kind introduction. Hi, everyone. Very warm greetings to all of you. Thank you for taking the time this evening and allowing me to share some of my thoughts on Bitcoin trading and investment. Okay, so if you have any questions throughout the session, just type in the question box. And if we have time at the end of the presentation, I'll try to answer some of them. Okay. Now, I should turn off the camera for now. Let us focus on the content of the slides. Right. This is a part that I should remind you that everything we talk about here today is for informational and hopefully entertaining purposes only, right? So it's not any financial advice. Please do your own research, especially when it comes to this very new cryptocurrency. Do your own research and fully understand the risks before you ever try to put any real money into the market. Okay, now, before we get started, I'll give a little bit of introduction to my company and myself. Synergy Link Capital is a Singapore-based proprietary trading firm. So the founders were mostly from major investment banks' prop trading desks. Right, so most of them started their career on the trading floor even before trading became electronic. So combined, our team have a lot of market experience as we have gone through multiple cycles of booms and busts. Right, so we have very, very deep understanding of risk management, and that I believe is one of our biggest edge in this industry. So last year, the partners of Synergy Link Capital actually decided to incorporate a new fintech company called Inspirante Trading Solutions. So the purpose of this is to keep Synergy entirely focused on trading and let this new fintech company to expand the business into, for example, providing solutions or doing trainings and webinars and stuff like this, what we are doing today. Now, a little bit about myself. I came from a computer science background and I joined Synergy about 6 years ago. So now I am a partner and director of both Synergy and Inspirante Trading Solutions. So I mainly trade global macro and some volatility arbitrage. And I do conduct training courses on trading or investing and related topics. I also publish a bi-weekly market commentary on CME. It's called Fresh from the Trading Room. The target audience are mainly retail traders. So I do have real-time market commentary and some actionable ideas. So you are free to, you're welcome to check it out and subscribe. Now let's get started. The agenda for today is first we'll try to understand what is Bitcoin and why it matters. And after that, we will see currently what are the different vehicles for trading and investing in Bitcoin. And after that, I'll focus on trading Bitcoin using the CME futures. And finally, we will be talking about the risk management in trading Bitcoin. Okay, now before we try to understand what is Bitcoin or what people envision this Bitcoin or even cryptocurrency to be, it is helpful for us to take a look at what is fiat money. Some of you might have heard it before, but outside economics, people don't really talk about this much, right? The fiat money, by definition, is a government-issued currency that is not backed by a physical commodity such as gold or silver, but rather by the government that issued it. Right. So note that throughout human history, for centuries, most of the currencies existed were not fiat money, as many were backed by gold or silver. Only when in 1973 the Bretton Woods system collapsed and the US dollar broke its peg to gold and it became a fiat currency. Then from then on, all modern paper currencies are fiat currencies. So many people argue that moving into fiat money system is a sign of advancement of the human society and modern economics and financial market, as the currencies are no longer anchored by some barbaric rock, as they call gold. So to a certain extent, they are right. The new fiat money system did help the government or the central banks to have much greater control over the economy by controlling how much money is printed and circulated in the system. For example, when the economy is in recession or in depression, central banks can increase the money supply to provide liquidity to the market and stimulate economic growth. On the other hand, when the economy is running too hot and in danger of rampant inflation, central banks can decrease the money supply in the system to cool down economic activities. However, there are some issues with the fiat system, which we can see that is becoming more and more severe since the 2008 Great Financial Crisis. The biggest problem with the fiat system also comes from the same reason we talked about just now. The central banks have the total control of how much money to print. The unfortunate consequence of this is that whenever faced with the crisis, be it a financial crisis like 2008 or a health crisis like COVID last year, the first and foremost, or rather most straightforward solution for a central bank is to print money and support the financial market, as we have observed throughout the world. This kind of money printing leads to broad asset price inflation, as we will take a closer look later. You may wonder, what's wrong with asset price inflation? Isn't price going up good for us, provided if we participate in these assets? Well, the real danger of such broad asset price inflation is that it didn't entirely come from societies increasing productivity. Instead, it's largely due to excessive money circulating in the system. What it means is that our real purchasing power gets hurt, and when price of everything goes up, yet our wage growth can hardly keep up. Now let's take a look at how money supply increased in the past 2 decades. Now, this is a chart of the Federal Reserve from the Federal Reserve website. It shows the M1 money supply in the US since the 1960s. M1 measures the total amount of cash and most liquid instruments that can be easily converted to cash. So for nearly 30 years, M1 increased by roughly 0.8 trillion to 2000. And then from 2000 to 2008, M1 increased by 0.4 trillion in just a short of 8 years. And from 2008 to 2019, M1 almost tripled to $4 trillion. And since COVID, M1 absolutely exploded. It went up to almost 5 times to 19 trillion. Now, this is another comparison. This is a comparison between M2 money supply and the hourly wage in the US. M2 money supply is broader than M1. It includes M1 plus some short-term deposits. So it's similar in many developed countries, including Singapore. So there is a ever widening gap between the ever widening gap shows the real purchasing power of our hard-earned wage are diminishing. So now, after seeing the massive increase in the monetary supply in the recent 2 decades, let's turn our attention to the balance of the US Federal Reserve, the balance sheet of US Federal Reserve. Before 2008 great financial crisis, the Fed balance sheet is roughly 1 trillion. In the next 10 years to 2019, it increased by 3 trillion, and that is after some tightening since 2018. However, in the last year alone, it increased by more than 4 trillion. Fed balance sheet doubled since the start of COVID. So all these may sound quite academic to you. So where can we observe the impact of such ballooning balance sheet? Actually, it's quite easy. Let's take a look at the stock market. First, we want to figure out what is really driving the market up. People used to believe that the stock market is the barometer of the fundamental economy, but I would like to argue otherwise. I think the central bank now plays a much bigger role in driving up the equity prices. So when we overlay the Federal Reserve balance sheet and the S&P 500 index, it gives us a pretty good idea what is really driving the market up. They have shown some very stunning correlation here. Okay, so as we can see here, the blue line is the Fed balance sheet, and the orange line is the S&P. So both index quadrupled since 2010. In last year alone, Fed balance sheet doubled to 8 trillion. And we can also observe that when the Fed balance sheet is expanding, the equity market enjoyed a very nice, smooth rally. And when the Federal Reserve balance sheet stops expanding or even shrinks, then equity market volatility increase and we have some mini crashes. So given the response of central banks when they face with crisis, I believe that the balance sheet will continue expanding. Hence, financial asset price inflation will continue to go higher. Fortunately, somebody foresaw this problem in 2008. Bitcoin was born in the rubbles of the great financial crisis. It was invented by some mysterious person or group of people who is by the pseudonym Satoshi Nakamoto. It's revolutionary in many ways, one of them being that Bitcoin is entirely decentralized and built on top of the blockchain technology. The very first block, what we call the Genesis block, carries this piece of text information. The Times, January 3rd, 2009, Chancellor on the brink of second bailout for banks. So this was actually taken from the title of this particular article on the newspaper on that day when UK was to bail out another bank for billions of taxpayers' money. So it's historic and even if you think about it, heroic, like the phoenix born from the ashes of the great financial crisis. Now, without getting too deep into the technical aspect of Bitcoin, I want to focus on the comparison between Bitcoin, gold, and the fiat currency. As at certain stage, they are all considered as a type of money or the store of value. Now, first and foremost, Bitcoin has the highest scarcity. The total supply of Bitcoin is mathematically defined to be 21 million coins. Nothing and no one can create one extra coin after these 21 million coins. In that regard, gold is also scarce. That is partly the reason it has been used as money and the store of value for centuries. However, imagine one day we discover another planet or meteorite with plenty of gold element. Assume that this is economically viable to mine gold and bring it back to Earth. This will break the scarcity of gold because now we suddenly have another huge supply of gold now. So it's logical to think that the price of gold would drop. Now, fiat currency, on the other hand, has the worst scarcity as compared to gold and Bitcoin. As we have explained earlier, central banks can simply print and create more money out of thin air. Bitcoin is also decentralized. There isn't any centralized governing body that is in charge of issuing new coins or verifying or clearing Bitcoin transactions. Bitcoin network is extremely secure. Because it is decentralized, there are thousands of nodes in the network that work very hard to help secure and verify every transaction. The reward mechanism makes sure that for all the actors, keeping the integrity of the entire network is in their best economic interest. And Bitcoin, and Bitcoin is also easily transactable. It is particularly applicable in some countries where money remittance is inconvenient, tedious, slow, or expensive, or even impossible. So unlike transferring the US dollar or, for the matter, any other fiat currency, in which both the parties needs to have a bank account and the middleman, which is the banks, charge a hefty fee, especially on cross-border transactions. For Bitcoin, you can transfer to anyone with a valid Bitcoin wallet address anywhere in the world at any time. And the transaction is almost instantaneous. It doesn't go through any middleman. So you pay a tiny little amount to all the other participants who work hard to ensure the security and validity of the entire blockchain, including your own transactions. And last but not least, Bitcoin is highly divisible. The smallest unit of Bitcoin is called 1 Satoshi. It is 100 millionth of a Bitcoin. At the current price, it's about probably 0.06 USD. So these are some of the most important characteristics of Bitcoin and the major differences as compared to gold and fiat currency. If you're interested, I highly recommend that you read the original white paper of Bitcoin. You will be amazed at the elegant solutions. Now, it was a funny incident that on July 12th, 2017, the Fed chair, Janet Yellen, was speaking to the House Financial Service Committee on TV. Someone held a buy Bitcoin sign during Yellen's testimony to the Congress. It is quite ironic, as we can see from the screenshot. Yellen was strongly opposing to audit the Fed. And at that time, Bitcoin was trading around 2,400 US dollars. Now, fast forward to today, there are already quite a number of big institutions that publicly adopted Bitcoin. So for example, Square moved 5% of its cash reserve to Bitcoin. And MicroStrategy, I think that's the loudest and most famous one, has so far accumulated about $6 billion worth of Bitcoin. Tesla also invested heavily in Bitcoin, and at one point, it also accepted payments in Bitcoin. And Microsoft accepts payments by Bitcoin to purchase App Store games and applications. PayPal accepts Bitcoin, Ether, and Litecoin for payments, and you can buy cryptocurrencies on the platform. Shopify also accepts Bitcoin and Ether for payment. And finally, the big financial institutions such as Goldman Sachs, JP Morgan, and Morgan Stanley have all open access to cryptocurrencies to their high net worth clients after years of criticizing Bitcoin. But most exciting of all is that some of the biggest funds are actively working with the regulators to launch Bitcoin ETFs in the US. When that investment vehicle becomes available, everyone, including the biggest institutional money, such as the pension funds, the sovereign funds, they will be able to participate. So now let's take a step back first and try to answer this question: what is driving the Bitcoin price up, hence making institutions eager to participate? Well, the answer is the network effect. So the network effect says that the value or utility of a user derives from a good or service depends on the number of users of compatible products. Right? So when you see some of the examples later, you can easily understand what it means. Network effects are typically positive, resulting in each user deriving more value from a product and as other users join the same network. So the adoption by an additional user can be broken into two effects. The first is a total effect, which means an increase in the value to all other users. And the second is marginal effect. That means the enhancement of other non-users' motivation for using this product. So imagine these are the few examples that we are all very familiar that enjoy the network effect, such as telephone, internet, Facebook. Just imagine when telephone was first invented, imagine that you are the only one in the country who has a telephone. Telephone actually has very little value to you because you have no one to call. Right? The same thing goes for the internet, for social media, and for Bitcoin and other cryptocurrencies. The more people use it, the more value this whole space has. Now, this chart illustrates the point. We can see clearly that the number of addresses, you can think of it as the number of users who have Bitcoin, goes up together with the Bitcoin market capitalization. And a few months ago, Goldman Sachs published this research paper on cryptocurrency valuations and their network size. We can see that not only Bitcoin, but many other notable cryptocurrencies all fit this model very well. So Bitcoin is just the earliest and the largest by network size and market capitalization. So in summary, these are the reasons I think that why we should invest in Bitcoin. First of all, because of the network effect and the fact that the entire digital asset space is still in very, very early stage, it offers us very attractive risk reward. And secondly, it is a source of independent alpha to a investor's portfolio. With the traditional asset classes and extremely low interest rate environment, it is right now very hard to find source of alpha. So a small proportion, such as 1 or 2 or 5% of the portfolio invested in cryptocurrency, can meaningfully boost portfolio performance. And thirdly, for small investors like us, it's a rare opportunity that we can front run the big institutions because this entire space is very new. Regulators have been moving very slowly, therefore creating a barrier for big money. And we, as a small investor, are much, much more nimble than them. And finally, just like gold or the US Treasury, Bitcoin has the potential to be the so-called pristine collateral for the digital age. So what it means is that even though Bitcoin may not be designed to do every task in the financial market, and eventually there will definitely be new cryptocurrency inventions that do really well in certain aspects, such as payments, loans, insurance, etc. Bitcoin will continue to serve the purpose as the anchor and the foundation of the entire space. So, for example, in the future, other cryptocurrencies may no longer be quoted in US dollars, right? But it could very possibly be quoted in Bitcoin terms when the volatility of Bitcoin quietens. And for now, I have to say that we haven't reached there yet, and it is still a very, very volatile asset, and there are still a lot of issues that need to be addressed, as we will see later. But I just don't think that Bitcoin will ever go away. Now, let's talk about the different investment vehicles that we can invest in Bitcoin. We will go through them one by one. The very first one and the most secure way to invest in Bitcoin for the long term is to buy Bitcoin and to store it in your private wallet. There is a saying in this cryptocurrency space, if it's not your keys, it's not your coins. What it means is that only when you have the private key to the wallet, you then own the digital asset. And without the private key, at most, you only have access to the digital asset. So even on Binance website themselves said it very clearly that you are not really in possession of your coins. Instead, the exchange holds and manages your funds on your behalf. Right. So in terms of private wallet, there are two types of wallet. There is a hot wallet, which means it's a software running on your own computer. And there is a cold wallet. It's a piece of hardware like a USB drive. When you disconnect this cold wallet from your computer or from the internet, it basically means no one in this world can ever take that away from you, as long as you have the hardware and you remember the password. But this way is, I believe, the most secure way to invest Bitcoin in the long term, but it is not suitable for short-term trading because it's troublesome and sometimes it can be expensive to move your Bitcoin in and out of your wallet. Now, the next vehicle is what we all know as the crypto exchanges, such as Binance, such as Coinbase or CoinHako for our local Singaporeans. As we can see these market depths on Binance, it's actually very healthy. We look at the bid-ask spread as traders, and we can see the bid-ask is pretty tight. However, if you don't have enough confidence or have the access to these crypto exchanges, you can also consider a proper Bitcoin trust. So Bitcoin trust is another way for investors to buy or sell the shares of the trust, just like any other US securities to invest in Bitcoin. However, because of the structure of the trust, this particular Grayscale Bitcoin trust, because of the structure of the trust, its shares can't be easily created. Neither is there an active redemption program, unlike most of the common ETFs. And because of the fact that for a long time, this is actually the only available option for many investors. So there were persistent premium to the net asset value of this Grayscale GBTC, simply because there is an imbalance in demand and supply. So if you're a long investor, you not only have to pay high management fee of 2%, but you're also buying the shares of GBTC at a premium. That was the case for many years. So from this chart, we can see up until February of this year, GBTC was always trading at a premium to the NAV. Only after that, it dropped to a discount. So the Citron Research, Citron was one of the most famous short sellers. Citron Research published a paper in as early as 2017 to short this GBTC security, because at that time the NAV premium was 70%. So it was calculated by taking the GBTC Trust Bitcoin holdings valued at the spot BTC price versus the GBTC market capitalization. But as I have mentioned, regulators have been moving very, very slowly. And for a long time, GBTC was the only option available to investors. That's why many people still chose to invest in this vehicle. But the good news is that GBTC is fully aware of this issue, and they commit itself to eventually converting into an open-ended ETF. Now, there is also a BTC ETF, just like the ETFs that we are familiar with. However, it is in Canada. It's called the Purpose Bitcoin ETF. It is the world's first Bitcoin ETF, and the management fee is 1%, much lower than the GBTC. Now, other than directly investing in Bitcoin or the ETFs or the trusts, investors can also participate by investing in the public companies that have exposure or businesses in this digital asset space. So for example, MicroStrategy, Tesla, Galaxy Digital, Coinbase, and so on. However, please be very careful about investing in these companies because there are many other factors coming to play now, such as their business model, their financial conditions, and so on. So you need to evaluate them individually. So I believe it is now no longer a pure Bitcoin play. Personally, the safest and easiest way for me to trade Bitcoin is via CME's Bitcoin futures. CME has the Bitcoin, the standard BTC and the micro BTC futures, which whose contract size are 5 Bitcoins and 0.1 coin respectively. So they are both financially settled, and the micro contract, although only launched very recently, is showing very good trading volume and open interest. The micro Bitcoin is, I believe, very suitable for new and small investors because 0.1 coin at today's price is only about 6,000 US dollars notionally. There are many reasons investors prefer cash settled futures, primarily because of the convenience that you don't need to deal. You don't need to deal with the delivery process and so on. And just like most of the equity index futures, like the S&P that we trade. This is a chart showing the volume and the open interest of CME BTC futures. It's picking up very nicely, suggesting that I think more market participants are coming into this market now. And when comparing to major crypto exchanges on the Bitcoin future open interest, CME currently rank 3rd. And in terms of the trading volume, CME rank 4th right now. Now, the Bitcoin Futures ETF is something very new. In fact, this is happening as we speak. And I believe this ProShares Bitcoin Futures ETF with the ticker BITO starts trading tonight. It is different from the ETFs we have described just now because it only has exposure to Bitcoin future contracts, but not to the spot market. And in the SEC filing, it actually stated that the only such contracts are traded on are subject to the rules are the CME Bitcoin futures. So a possible impact, in my opinion, of such a vehicle is that it provides yet another way for big institutions to invest Bitcoin in a much safer way. Because now they can do so without the concern of counterparty risk or the custodianship of the actual coin. So there will be, I believe there will be increasingly more trading activities and open interest on the CME Bitcoin futures and the micro Bitcoin futures. At the same time, it also invites other type of market participants, such as those who can efficiently access both the futures and the spot market. So they can therefore market make and even carry trade these futures and spot pair because of the contango term structure in the futures. And as we can see here, there are actually a lot more Bitcoin futures ETF coming, waiting for the approval of the SEC. So it is quite obvious that even for Bitcoin futures side, we will be seeing a lot more activities. Now let's talk about some of the risks. In my opinions, these are the 4 major categories of risks involved in Bitcoin or, for the matter, any other cryptocurrency trading, and I will explain each. First and foremost, as this entire space is very new, regulators were not able to keep up with how fast things are moving. Since day one, many people have believed that there's no way the government would allow such a decentralized money system to exist, because government needs to have a control over the money, and I don't disagree. However, I view the slowness of the regulators not as a negative risk, but more like just uncertainty. And I think we need to embrace regulatory uncertainty, because even though there are risks, that is also where the upside potential comes from. Now, we are betting on the digitization of future financial systems, right? Nobody knows for sure how long the change really happens, or how it's going to be 10 years down the road. But we can certainly take a calculated bet that digital assets and cryptocurrencies will not disappear, but they will become more mainstream in one form or another. As mentioned before, the regulatory risk creates the barrier for big institutional money, such as the pension funds and sovereign funds. So now we have the very rare opportunity to position ourselves before they do. Now, the next risk is 100% negative risk that we should try our best to avoid in order to safeguard our investments. And this is the counterparty risk. There are countless cases where crypto exchanges got hacked, lost money, or the founders just took the money and ran away. So after all, these exchanges are under-regulated, and remember, your coins on all these exchanges don't really belong to you. So even the biggest crypto exchanges are not entirely risk-free. Therefore, my advice is to separate short-term trading from your long-term investment. For long-term investment, if you truly believe the future of Bitcoin and other cryptocurrencies, go get a cold wallet and store it in a safe place, and never forget the password. And this way, no one can take the digital asset away from you. However, for short-term trading, if you want to trade Bitcoin, I highly recommend CME's BTC or micro BTC futures. Because CME is one of the largest futures and options exchange in the whole world. It is highly regulated, and the counterparty risk is negligible as compared to the online crypto exchanges. And if you really want to trade other coins that you have to use one of the crypto exchanges, I think you should only put in the money that you can afford to lose, because it is not a immaterial risk that the exchange may go bust, or you may lose all of your digital asset on it. Now, the stablecoin risk is something I consider to be right now the biggest challenge faced by not only Bitcoin, but the entire crypto market today. If you look closely at many crypto platforms, you may find that coins are usually quoted in USDT, as in Tether, instead of the US dollar, the fiat currency. Most of the time, the price look identical because supposedly one Tether should always peg to one USD. That is why it's called a stable coin. However, there are a lot of controversies around Tether, specifically on whether it is really backed by cash or equivalent as they claim. Due to time constraints, I wouldn't go into the details and the technicalities and the history of this issue. However, I highly recommend that you listen to the recent podcast by Grant Williams and his report on Tether. It is available to the public on his website. So even the Federal Reserve had published a paper in June talking about the potential risk to the entire financial stability posed by stable coins like Tether. And in late February, the New York Attorney General's office settled with Bitfinex and Tether on charges relating to financial mismanagement. In a statement, the NYAG said that Bitfinex and Tether recklessly and unlawfully cover up massive financial losses to keep their schemes going and protect their bottom lines. Tether's claim that its virtual currency was fully backed by US dollar at all times was a lie. So allow me to simplify this for you. If it turns out that Tether is a gigantic fraud and not in fact pegged to USD 1-to-1, it will absolutely cause havoc to, I believe, the entire cryptocurrency and digital asset space. However, I have to say that this problem is not something new. Doubts about Tether and has been there for a few years. Is the market already priced in this information, or is the market just chose not to see it? Honestly, I do not have an answer for this question, but I want to be very, very careful and mindful of this risk. So as I said, if you want to mitigate this risk, you could consider avoid holding Tether. There are other stable coins which is supposedly more reputable, and I highly recommend this podcast by Grant Williams. Now, finally, the weekend risk. Many people talk about this because Bitcoin trades 24/7, whereas most of the other financial instruments like CME futures do not trade on weekends. However, I don't think this is a material risk that is unique to Bitcoin. It exists actually for all other commodities. When the futures market is closed, it doesn't mean that the actual physical market is not moving at all, like the oil or the agricultures and so on. So the key thing here is to properly size your positions and control your risks, just like trading any other product. So talking about position sizing, I want to show you this very rough sketch of different asset classes, volatility, and potential return. So note that at the bottom left corner is cash. It can be considered as risk-free, but because of the low interest rate and inflation going a lot higher, the real rate is actually negative for holding cash as the purchasing power gets eroded by inflation. Now, move along this curve, you will have the money market, the government bond, and then the corporate bond, the index ETF, the large caps, the small caps, the emerging markets, the private equities, and the VCs, and so on and so forth. Finally, Bitcoin is undoubtedly at the top right corner. It has the highest risk and volatility, but it also has the highest potential return. But when we are constructing a portfolio with different assets, it is usually a good idea to size the positions according to the volatility, which means the higher the vol, the smaller the position. So it's a great idea to put, let's say, 1 or 2 or 5% of the net portfolio into Bitcoin, but it's a terrible thing to put, say, more than 50% or even taking leverage to trade this super high vol asset. So my advice is never trade cryptocurrency with leverage. Lastly, after what I have shared in the past 40 minutes or so, I hope you can see my stance on Bitcoin. First and foremost, I am a trader, and I can see the potential of Bitcoin, of cryptocurrency, and of the entire digital age. And I believe there is a high probability that this will work out. However, I'm not a diehard Bitcoin maximalist who thinks that Bitcoin is flawless or Bitcoin solves every problem. And everyone who argues otherwise is just stupid. I'm not. So I see a lot of these kind of mentalities online, and I think it is very toxic. So I can see the potential problems. Some could be existential problems to Bitcoin, such as Tether. But as a trader, I want to focus on the opportunities. So if you're not 100% convinced one way or another, my advice is just follow the trend. The trend is always your friend. So this chart is the backtesting of a very simple trend following strategy. It works marvelously on Bitcoin and other cryptocurrencies. For example, it got me into Bitcoin when the price was just about 10,000 US dollars and got out above 50,000 to avoid this massive drawdown last a couple of months ago. And now there's a re-entry signal again. So as you can see from the green regions, the trend following strategy can easily capture the bulk of the move when there is a big trend, and it can help you to get out of the position when the trend start to turn down. So that is more than enough to compensate for the interim whipsaws. There will be whipsaws, but because of the nature of this exponential move in the digital assets, as long as you can capture these few big trends, it will be more than enough to compensate. So I have to say that the crypto market is indeed a trend follower's dreamland. Okay, now we come to the end of my presentation. If you have any questions, please feel free to let me know. We can discuss here. Thank you.
All right, thank you so much, Zuhao. Members of the audience, if you have questions from Zuhao, please head down to the question box and type them in. And we will address them in the Q&A session, which is to follow right now. Zuhao, are you all set to go? We have a few questions coming in right now.
Sure, please. I can't see the questions. Do you mind reading the questions to me?
Yeah, sure. Okay. Somewhere early on in your presentation, you mentioned source of alpha. Would you be able to explain that further?
Okay, source of alpha. Because at this point, a lot of the what I meant as independent source of alpha is that Bitcoin, or rather the entire digital space as of now, is pretty much uncorrelated with the rest of the traditional asset classes. Right. Of course, it doesn't mean that you know during VAR events, right, liquidity events like last year March, it doesn't mean that the Bitcoin will entirely be unaffected. It will be affected, but it will not be as correlated as, for example, we're talking about equities versus bonds, or the US dollar, or the gold. Right now, most of the traditional assets and are pretty much, I would say, sometimes when an investor construct a seemingly diversified portfolio, for example, they have stocks and bonds, they have some precious metals, right? They are implicitly, for example, either long vol or short vol, either long inflation or deflation, right? So it is because a lot of the assets are highly correlated. So the portfolio is not as diversified as the investors believe. Whereas when we adding a little bit of these very uncorrelated assets, such as Bitcoin, it helps to boost the entire portfolio's performance. As if the audience is interested, we can actually do some very simple back testing, right? So let's say you compare a traditional 60-40 portfolio versus, let's say, a 60-35 and 5% Bitcoin portfolio. You can see a massive outperformance in the past decade. So this is what I meant by uncorrelated independent alpha to the portfolio.
All right, thank you for that, Zuhao. Next question is from Kenneth. He's asking if there is a EFP feature for CME Bitcoin futures.
Sorry, what EFT future?
EFP feature. Would you know what that is? If not, we can jump on to the next one.
EFP, if No, I don't think CME has that future has that yet. Right, as of now, CME only has this standard Bitcoin, micro Bitcoin, and the standard Ether. These are the only three future crypto futures on CME as of now.
All right, so this next question is from Mike. He's asking, how would one go about setting up a cold wallet? Would hardware failure be an issue, like faulty USB or something like that?
Okay, when I refer to a USB, it does not mean it's really a USB drive, right? It's a manufactured hardware piece that looks like a USB. In terms of the size, the shape, it looks like a USB. I would say that the reliability is a lot higher as compared to your normal desktop, right, or the laptop, because or even your handphone, because these hardware wallets are built specifically for the purpose of storing these digital assets. And the complexity, of course, in the crypto sense, as in cryptographic sense, the complexity is high. But in terms of the engineering, it's not as failure prone as compared to the modern electronic gadgets. So I would say that cold wallet is definitely a lot safer, right? Because even if you have a hot wallet on your desktop, right, your desktop can one day, motherboard failure, disk failure, anything can happen. Whereas a cold wallet, the chances are much lower, right? So one of the cold wallet is called Ledger. I think the audience can easily Google this, Ledger Nano S or something. That's the one I'm using it personally. And I know a lot of long-term Bitcoin investors or cryptocurrency investors, they're all using Ledger.
All right, thank you. All right, next question is quite interesting. We have seen the Chinese authorities crack down on cryptocurrencies. What's your opinion on whether the local government might want to regulate Bitcoin trading soon?
Well, first of all, I can't really say for sure what is the reason that the specific government want to regulate cryptocurrency, right? It's not only China. Actually, every single country has a different stance, right? US has its stance. El Salvador was the one that made Bitcoin a legal tender not long ago, and I think Singapore is pretty, I would say, pretty open and pretty welcoming to the new fintech blockchain-based technologies, right? As long as it can comply with the, for example, anti-money laundering and all these regulations, right? So I can only say that after the Chinese government's ban on crypto, there was a lot of the miners actually got out of China or stopped operating in China. And during that short period, we did see a crash in the crypto asset prices, but as we can see today, it fully recovered. So that speaks even more about the resilience of this Bitcoin and this new digital asset. So I'm not sure how eventually it's going to play out in individual countries. But as I said during the presentation, I want to embrace regulatory uncertainties. I want to see this as an opportunity, because this is still, after all, this is still a wild west. It's still at a very early stage.
Very interesting analogy, Zuhao. All right, for people who are new, what would you recommend how you can utilize the strategy that you mentioned about following the trend? What should be the indicators for buy or sell signals?
Okay, actually, I would say that if you are familiar with any type of trend following strategies, okay, you can try to test it on Bitcoin on different different signals, different indicators, different time frames, right? Because it's really depend on your trading style, your personality, and your, for example, your capital, your holding period. These are all different to individual traders. What I'm saying here is I'm not trying to teach a specific set of strategy that can, you know, just make money on Bitcoin. What I'm trying to say here is that for this particular asset, not only Bitcoin, but the cryptocurrency asset, there are very strong behavior of trends, right? Just like maybe 10, 20, 30 years ago, right? If some of the audience have heard of this Turtle program, Turtle was one of the pioneers in trend following. So at that time, most of the assets were pretty trendy, right? At least much more trendy than nowadays. And the trend following worked very well back then. And that is why I think for cryptocurrency space, it's still a lot more trendy than most of the assets, most of the other financial assets. So I'm pretty sure if you do some homework, try to, you know, try to pick up some very simple trend following strategies. It doesn't need to overcomplicate. Just a simple entry rule, a simple exit rule, and, you know, with a little bit of programming skills or even just Excel skills, you can test it out. And if it works, remember, one of the most important principles in trend following is that you have to follow the system, right? Because if you were to trend follow this, I'm sure throughout the whole process, you will experience a lot of small losses, right? That's the nature of trend following. But what you're hoping for is by sticking to the system, right? Always take the signal, right? And eventually you will be able to capture the outliers, and the outlier is where, you know, the bulk of your profits should be from.
Okay, so the next question is, unlike equities, what drives Bitcoin prices? Does Bitcoin generate any revenue or profit just like a company does?
Yes and no. Bitcoin itself, I think it's better to think of it as a utility, right? For example, you wouldn't think the U.S. dollar is a company, right? Or it generates revenue. It's not. U.S. dollar itself is a medium of exchange, right? So it facilitates the world trade and a lot of other things. And by doing that, by everybody adopting the U.S. dollar system, right? That creates value to the dollar or to the credibility of, say, the U.S. government or the U.S. dollar itself, right? So same thing for Bitcoin. I'm not necessarily saying that Bitcoin is going to replace U.S. dollar or Bitcoin is going to be the next money. It may not be, because it's probably not designed to be this way, right? Because if we look more into the technical details of Bitcoin, the transactions it can handle is pretty limited, as in the throughput, the transactions per second, as compared to the traditional, say, Visa and Master, these networks, they can handle much more transactions, right? So for it to be a medium of exchange, to be a money, it probably doesn't fit the picture yet, right? But it doesn't mean that it's worthless. As I said, it could be the pristine collateral. It could be the anchor of this new crypto space. Right? So instead of transacting in Bitcoin, Bitcoin could be the one that you use to store your value, right? So when you need to transact or when you need to do something else, you could exchange your Bitcoin into a specific other coin, right? But when you want to say, okay, I want to preserve this value, I want to store the value, I could put in Bitcoin because this is, for example, the largest or the most stable cryptocurrency. Yeah, so that is my answer. Right? It doesn't really so-called create revenue like a company, but it's more like a utility, like telephone, like you know. So where the money comes, where the value comes from, I think is the network effect. Right? The more people use it, the more value the network has, and at the same time, the more motivation the non-users will have to jump in. Right, so eventually you will, I believe you will be seeing exponential adoption, right? Not only in Bitcoin, but in these entire digital assets. Yeah.
All right, so last question before we wrap up the session. For those of you who have questions unanswered, we'll address them in a follow-up email. If you have more questions, you can also send them in the survey form right after this webinar. All right, for our last question, would you be able to touch on what you shared earlier? How would a portfolio with 1 to 5% of Bitcoin compare to 100% all equity portfolio, and would the former outperform the latter?
Well, no. With a portfolio with cryptocurrency would definitely, okay, at least let's say based on historical data, would definitely outperform a traditional 60-40 or even 100% equity portfolio. Just look at how Bitcoin have advanced in a short span of a couple of years. Although Bitcoin was invented in 2008, it came to so-called mainstream, or it became widely known in the last, I would say, 4 to 5 years, right? So even let's say we construct our portfolio at the end of not at the end, let's say we have experienced one round of boom and bust in 2017, if I'm not wrong. At that time, the highest point of Bitcoin is about $20,000, right? So let's say if we take the worst case scenario, okay, we enter Bitcoin at that time, okay, and of course subsequently we experience quite a bit of drawdown, but eventually till now the Bitcoin value tripled, right? Triple. This is the worst case, right? The most conservative case. And if you were to invest Bitcoin at any better time, right? For example, much earlier, or if you can dollar average it, or any other way would make your portfolio perform even better, right? Whereas you look at equities or equities plus bond position portfolios, right? Average, I would say maybe a 30% at most annualized return. But for Bitcoin, we are talking about 10x, 50x, 100x kind of returns on Bitcoin. So when you add that as a small portion of your portfolio, it greatly boosts the portfolio performance, right? And it doesn't really hurt your bottom line a lot, right? For example, if let's say one day it turns out this whole thing is a gigantic fraud and Bitcoin goes to zero, okay, you lost what, 5% of your portfolio. I think that's very bearable kind of drawdown, right? But on the other hand, if Bitcoin really goes mainstream as we hoped, right, it can go up a lot more. So what we talk about here is the asymmetry, right? The risk reward is so imbalanced, right? On downside, you have a very clear idea of how much you are going to lose if it turns out to be not what you have hoped. But on the upside, the upside is way bigger than the downside. So that's why I think it does add quite a bit of alpha to the portfolio, provided if you construct it carefully, as in risk manage it well, position size it well.
All right, thank you so much, Zuhao, for your valuable insights today.
Thank you. Thank you,
All
everyone,
right, thank
for
you
your time.
Thank you, Zuhao. And thank you for being a wonderful audience with all those exciting questions. I'm sure you gave quite a challenge to our speaker today. If you have more questions, please send them into the survey form right at the end of the webinar. Till our next live webinar, stay safe and take care. Bye-bye.
Bye-bye.